Welcome and thanks for joining us. My guests today are Jay Fee, the Vice President of Consumer Banking at PenFed Credit Union, Chris Klaczynski, the Director of Direct Auto Lending at PenFed Credit Union, and Sean Worthy, the Assistant Vice President for Corporate and Business Development at PenFed Credit Union. It's a real pleasure having you here. And just to kick off this conversation, one of the first things I wanted to ask you about is auto refinancing. It's something that is a word that we hear a lot, but I'm not sure that everyone knows exactly what it is. I certainly am not as up to date on it as much as I should be. So I'd like to really just learn a little bit about it, if you wouldn't mind telling me.
Yeah, thanks, Scott. Auto refinancing, as the name implies, is fundamentally it's the reducing of your interest rate and also hopefully you're lowering your auto loan payment. And so 80% of the public really doesn't even understand that you can refinance your auto loan. Of course, most of us are familiar if you have a mortgage that, yeah, you can refinance your mortgage at a lower rate. We get advertisements for that all the time. Student loans, obviously, has picked up a lot over the last 5-6 years. There's also been a large growth in refinancing the auto loans. And fundamentally, it's actually easier to do than refinancing a mortgage. And we'll talk a little bit about that in a little bit. It's more about public awareness. And so we're doing our best here at PenFed to make sure that people are aware that you can get a low rate, probably lower than what you have. And there's a lot of reasons why you may not have gotten a rate as low as you could have when you originally got the loan. That could have had to do with maybe you got some dealer incentives that were more towards lowering the price of the actual auto loan, or maybe it might have to do with the fact that your credit score has improved greatly since then, and that the lender that you are getting the loan from was basing it on your prior credit score. So over time, basically, a lot of people take a look at their auto loan as it continues to actually amortize and the balances go down, and they look at their auto loan and some of them say, it's not really kind of worth the trouble. But when you kind of consider that you can save probably somewhere between $100 and $150 a month on your auto loan, if you find the right lender, it can be a significant savings over the life of the loan or just in your monthly payments.
That certainly adds up. And you preempted part of my question, which is why would a bank want to take the risk on you? And that sounds like, over the time of a loan, you can figure out what your credit score getting better. You can, pay your bills. You're increasing your credit score by also paying off your car loan in general. So, there's many reasons that a bank might want to take that risk on you and go ahead and refinance with you, right?
Absolutely, and there's a lot of types of candidates. Obviously, for auto refinance, almost everybody's is a candidate, but some people can save a lot more than others. And generally, a lot of those folks are certainly people under the age of 35, because if you generally get a 6-7 year auto loan, which a lot of people do these days, and you're a year or two into it, when you got that loan, you may have had a completely different pay structure. You may have had a completely different debt structure than you had before, and you may not have even had a demonstrated payment if it's your first auto loan. And all of those things help improve your credit score, and those are things that banks and credit unions and other financial institutions look at before assigning the actual rate to your auto loan.
So, we've established what these are. How do you actually do it? How do you get one of these refinances?
Yeah, I'll jump in there. Hey, everyone, this is Sean. Scott, good morning. It's actually really easy. When you compare, like Jay mentioned, an auto refinance to a mortgage refinance, certainly a mortgage refinance is a very thorough process with the appraisal, the application, the underwriting. It's very complex. With an auto refinance, it's really similar to getting the initial auto loan. The most important thing I think that Jay alluded to is putting yourself in a better financial position. So certainly borrowers or applicants, consumers who have either improved their credit profile, credit, like FICO score, credit score is really only one of the variables here. But certainly consider, if your credit score has improved since you got that initial loan, that's one of the most important factors to determine whether or not you're going to get a better interest rate, which inevitably is going to allow you to save more over the life of the loan and interest that you actually pay to the financial institution. So understanding kind of where you were and where you are and what your goals are, whether it's just lowering your monthly payment, lowering your interest rate, will, I think, help frame up whether or not you should consider the refi. But inevitably, there's a lot of banks and credit unions out there that offer auto loan refinancing. And essentially, it's as simple as going and finding a lender like PenFed and seeing what the options are, what the rates are, and filling out a loan application. From there, we're going to ask for things. If you come to PenFed to refi an auto loan, we're going to want to understand what the current payoff quote is. So if you finance with another lender, you're trying to bring that loan to PenFed or any other credit union or bank for that matter, we're going to say, okay, what do you currently owe to that lender? So you go get your payoff quote. And that's basically the amount you're applying for with the auto refinance. From there, we're going to ask maybe, obviously, the standard questions, right? Run your credit to make sure you're a qualified borrower. We'll assign the rate. And from there, you'll be able to see what the savings are, both in monthly payment. And if you get a lower interest rate, which is really the goal of an auto refi, you can understand the amount that you would save over the life of the loan in the finance charge. So as you're shopping or considering an auto refi, I would advise to go out, certainly start on Google, start to shop what auto refinance rates look like. PenFed is kind of one of the leaders in the space in terms of having great rates. It's one of the things we're known for. So you can certainly visit our website, look at what the rates are that we have advertised, and start to run some of the calculations. We have a calculator that you basically plug in what your current rate is, what the potential new rate is, how much time, so how many months you have left on that current loan. And in a lot of cases, let's say you finance that first loan at 72 months. Here you are 12 months down the road, so you've got 60 months remaining. You could basically run a calculation to say, okay, I don't want to extend the term. I want to, only make 60 more payments. I don't want to make additional payments from what I originally financed. And just by lowering your interest rate 25, 50, 100 basis points, so 0.5% or 1 full percent, over spread across $20,000, $30,000, there's a tremendous amount of savings you could realize, over the next 5 years making that payment. So kind of to sum it up, it's very simple. A lot of firms like credit unions, like PenFed or other institutions have, really a very seamless application process, which can be done in 3 to 4 minutes. And really the only other thing you have to consider is, changing the title, from maybe whoever the current lender is to PenFed or whomever you decide to refinance with. So in a nutshell, it's actually a very, very, very simple process for the consumer.
And, a lot of these loans and mortgages together are, they're top heavy when it comes to paying off the interest versus paying off principal. Does that still make it worth it, going in halfway through your auto refinancing or your auto financing to refinance again? Are you still going to come out ahead in that situation?
Yeah, absolutely. And kind of alluding to the points I made prior, if you take your current situation, right, let's say you have a loan at 5% and you have 60 months remaining on that loan. The loan amount is, let's say, $20,000 at this point. If you were able to refinance that loan to a rate of 4%, 3.5% for $20,000 over still 60 months, the calculation using an online calculator like I described will tell you the amount you're going to pay comparing those two loans over the life of the loan in terms of interest, right? The finance charge. And that alone, typically on that loan size and those interest rate, the difference in APR, 5% versus 4% or 3.5%, is going to be upwards of $500 to $1,000, just depending on what the loan amount is and what the comparative rates are. So absolutely, you can save over the life of the loan by refinancing.
So we've established what this can do for you. How do you know that you might be a good candidate for one of these? What's the sort of best profile that these banks or credit unions are looking for when when people are trying to refinance?
Hey, I'll take that one, Scott. To echo some of my colleagues here, I mean, number one, banks are in business to help consumers lend money. And there's a lot of, it depends on the individual situation of every customer. And for them, it's an assessment of, do I want to lower my payments? Is my goal to save money? Lowering payments would typically involve either, lowering the rate or extending the term, versus just saving money, saving interest. You're looking to reduce your total interest rate. We're here just to provide the mechanism and the tools to achieve whatever those goals are. As Jay alluded to earlier, if your financial situation's improved, you potentially could save some money. You're going to qualify probably for a better rate if your credit score's improved or your debt ratio's improved, and you might as well take advantage of it. A lot of these loans are low cost or no cost. You can pre-qualify to even get a sense of whether or not it makes sense. And as Sean alluded to earlier, there's plenty of tools and calculators out there. We have some on our website, penfed.org, where you can just go and see what makes best sense for you. But really, there's nothing out there that mimics to say what's best or not, because it really depends on everybody's individual financial situation and their goals.
So as someone who is under 35 and seems very likely for one of these sorts of situations, I wonder, how do I know when a good thing is coming my way? So, if I've realized that my credit score might be going up, or I might not even realize my credit score is going up, or my credit history is longer, and a bank might look at that, more optimistically. So what are some of the things that might make me more valuable that I might not even realize?
Yeah. Again, I think a lot of people today are empowered and they're aware. There's plenty of tools and information out there to be able to monitor your credit scores. If you get a new job, your income's improving, right? Those are some of the factors that lenders are typically considering. Yeah, it's your ability to pay, right? So if you think you're in one of those situations, and again, there's tools out there where you can pre-qualify without even looking at your credit. Or you can submit an application. It will post an inquiry to your credit. But again, it's up to the individual to make those assessments.
And Scott, another thing to chip in on here, we talked a lot about credit scores and obviously how that affects how you get a rate assigned, but another way that financial institutions, banks, credit unions actually set an interest rate is also with what's called loan to value. And so if you initially bought the car, let's say you bought it and it was worth $30,000 and you got a $30,000 loan, and you mentioned, hey, what about like people who might be 2 or 3 years in the loan, and your balance is down to 15? Should we really still be looking at that? You can obviously extend the term, but you should also look to see, okay, well, hey, my cars hasn't depreciated that much. It's at $20,000 now, and my loan balance is down to below 15,000. So that actually it gives you what's considered less than a 90% loan to value. 15% is of 20,000 is only 75%. And most financial institutions know at that point you're not going to walk away from that vehicle, so they're willing to give you a much better interest rate at that point. And so that is something that you should definitely consider when you're sitting there saying, okay, should I refinance or not refinance?
Two last things I wanted to cover before the break is cost and timing. Does this cost anything if you want to go in and check if you're available for a refinancing? And then secondly, is when you know is a good time? Is now a good time to do it?
Yes, I'll take the first part of that question, right? When you talk about cost, it's kind of a yes and a no. So if you look at a lender like PenFed, right, to apply to get a new loan, there are no costs other than your time, right? So you come to PenFed, you say, hey, I've got this loan, I want to refinance with you guys. Other than you taking the time to fill out the application, get the payoff quote, give us all that information so we can decide, hey, whether or not we want to essentially refinance that loan. There really are no costs directly with PenFed. We don't have an application fee. We don't have a processing fee. It's just your time. Now, there are different state requirements when it comes to like us reassigning that title or registering a title to a new lien holder. Those are typically very, very small costs. But from that standpoint, inevitably, no, there are no fixed costs with the lender. I will say there are providers out there. There's some really, really innovative fintechs out there that will handle everything I just mentioned for you. So they'll get the payoff quote from the old lien holder. They'll handle the payoff to the old lien holder. They'll apply on your behalf to a credit union or bank to switch that loan at a more favorable term and rate. However, those companies typically will charge like a processing fee, but you kind of have to make the determination for yourself. What's my time worth? Do I want to pay, let's say, a few $100s to this fintech to do this on my behalf? For some consumers, possibly. Although it's a relatively low effort to be able to like get a payoff quote and assign a lien to a new financial institution, for example. So you kind of have to make that call. But in a lot of ways, you could look at it like there are no fixed costs. There's no hard costs other than the time invested to do that refi. And Chris, if you want to kind of talk about whether or not it's a good time, I think you have a pretty good pulse on kind of the market and where we are given everything that's going on and where the interest.
Kind of similar to mortgage refinance or student loan refinance. What it really comes down to is right now is an amazing time because we're in a low interest environment. We're in an environment that interest rates have been decreasing over time. And so what that means is you could have financed originally a couple of years ago and probably your rate's going to be significantly less. But you could finance just a couple months ago and you still may be able to save. And there's a couple of reasons why, right? Because one, rates have continued to decline. And two, you don't know whether or not the initial lender that was giving you that rate in the first place was the best rate out there, right? There's plenty of banks, there's plenty of financial institutions out there, and they all offer different rates. So it's always a good time to kind of check out the market, get a feel for the market, and see whether or not you have some savings. So really, in this instance, it's particularly great because again, it's a declining market. On the flip side, you could be even in a rising interest rate market, and there's still that potential to save because again, we go back to those factors of maybe your financial position's changed, as Jay alluded to, you're in a better equity position in your vehicle. So whether interest rates are falling or not, you should always be aware and always be checking out the market if there's some savings on the table.
Plenty of hot irons to strike, it sounds like. We're going to take a quick break. I'm your moderator, Scott Maucione, on the discussion Smart Auto Shopping and Financing, sponsored by PenFed Credit Union on Federal News Network.